Hey everybody, Marty Mazzora here. Today is Tuesday, 23rd of January, 2024. Quick market snapshot for you clients. You'll get an email in the morning with this link, so this will be tomorrow morning's message on the blog. So I wanted to start actually with this morning's message, the written note that I titled Soft Landing Searches Near Record. And will AI optimism do the trick again this year? So interesting, the number of Bloomberg articles mentioning soft landing has now reached a level not seen since the early 2000s. This doesn't necessarily paint a comforting picture. You could maybe call it a contrarian indicator. So here we are today in terms of, again, Bloomberg articles with the term soft landing. And by the way, soft landing, I think the term is in the eye of the beholder. Clearly, the market sees a soft landing as no recession, that inflation comes down, the plane lands softly, get enough weakness in the economy in terms of the rate of growth to bring inflation down, and everything is Goldilocks, right? Not too hot, inflation comes down, not too cold, no recession, just right. So it's certainly something that sounds wonderful. In fact, it's something Wall Street would be hoping for. And so when you look back historically, right, here is where we had a real ramp up in soft landing articles. And that's around 2007. And we know what happened in 2008. Here we are with the record, right before the recession in the early 2000s, which in market terms was a 50% hit to the S&P and an 80% hit, believe it or not, to the NASDAQ. This was the soft landing that happened in the mid-90s, and this is the one in the late 80s before the early 90s recession. So over the last 35 years, with the one exception, the mid-90s, we didn't get the soft landing. We actually got a recession, and in the previous two scenarios, it was pretty devastating to people who were, say, 100% long the stock market. In the mid-90s, it came after a hiking campaign. It was not nearly as aggressive as the one we have now, and we did have a lot going on with an internet that was really coming on and creating some serious productivity for companies. So, it makes some sense in here. Maybe it's AI. In fact, the subtitle or the next title here was, will AI optimism do the trick again? Remember, it was kind of sparked with NVIDIA's earnings, and we were pretty much off to the races, late first half of last year. The rest of this I borrowed from our research partner or research provider, BCA. I preface that with, we pointed out that November, December was very impressive, very broad-based. However, so far this year, we're right back to that terrible breadth. And BCA comments on it. The latest rally, relatively narrow, with 7 of the major 11 equity sectors in the S&P ending last week red. Share of stocks trading above their 200-day moving average. I showed you that indicator is rolling over. It's actually a bearish divergence from price. These dynamics raise the question whether AI optimism will boost the broad index again this year. While an improvement in risk sentiment could continue to benefit these sectors over the near term, they are not immune to a deterioration in the macroeconomic backdrop if, as we expect, a recession later this year, especially how expensive they are. And I sympathize with that view. I mentioned that they also offer up what explains last year's resilience in the economy. Remember, the consensus was overwhelmingly recession last year. That didn't happen. Except for one of their teams, by the way, their global equity team. They were bullish on the economy last year. They're now bearish on the economy second half of this year. They explain last year's resilience, why they don't see it lasting, and why they're not constructive on stocks. Restrictive monetary policy bodes ill for economic activity. Yet this cycle, this downturn has been delayed due to the mountain of excess savings. I know we've talked about this a lot, rising from the extraordinary fiscal stimulus during the pandemic. Indeed, according to Atlanta Fed's GDP Now model, real GDP will come in at 2.4% in Q4. Yet, we expect the economic backdrop to deteriorate as these savings are exhausted and labor demand continues to soften. Remember, I showed you how job openings tend to lead the labor data, and job openings have been rolling over. So this kind of speaks to that. And so the risk-reward balance isn't favorable, and you know how we feel about that on a 12-month time horizon. So message there, of course, is what we've been preaching about the whole macro backdrop, but it's also one of what the breadth has been looking like. And just another look at that. Here is, as of today, the all 11 S&P sectors. And you can see that while the S&P is now positive on the year, and of course, here we go again with tech and communication, and now throw in financials, healthcare, and at least as of today, industrials, although industrials were down on the day. The other 6 sectors, so just over half, are still in the red, some deeply. Utilities are down 5%. Energy is down 5%. REITs are down 4%. Materials are down 3%, and so on. I mean, we still have consumer discretionary down 1.2%, and consumer staples kind of coming back are down 0.39% on the year. So folks, this is anything but a healthy all boats rise with the tide market still at this juncture. And then here's a look at the S&P 500 and the S&P equal weight. S&P 500 positive now on the year, equal weight still notably in the red for at least a 3-week period. And then I threw in the Russell 2000, which is 2,000 stocks, but in some small cap space. Really have staged a nice rally. We've been hitting on this on the technicals. I'll touch on it briefly in a minute. And you can see today it kind of rolled back over while the S&P was up, but you know, it was tech leading the way again, while healthcare was down and industrials were down, and the equal weight was basically flat on the day, up 0.05%. Financials were pretty flat as well. Energy was up a little bit, 20 basis points. Rates spiked up today, which is interesting. We'll look at rates here in the technical analysis here in a second. So today, and a lot of days have been unusual. Correlations have kind of gotten mixed up relative to how things have been trading. For example, today, interest rates were up, and tech, which is pretty interest rate sensitive, actually was up 0.43%. So that bucked the trend. Gold, which has been very sensitive to interest rates, was actually up 0.39%. So, you can read all kinds of things into that. We won't on a one-day basis. We'll say that stocks have bucked more of a higher rate trend here in the very short term. Now it is earnings season, right? Staples were up a whopping 1.09%. And that's a not small position for us. But Procter & Gamble announced pretty good earnings from what I understand earlier today. We'll get the detail on that here later. And I know the market's waiting for Netflix after the close. So when I'm done with this, I'll be interested to see what they have to say. So this is earnings season, so we're going to get a lot of interesting dynamics, first, of course, on an individual security basis, but of course, here in the not too distant future, we're going to get, these magnificent 7 stocks, quote, showing their earnings. So we could see some potential not small short-term moves in either direction as those earnings come out. So in a nutshell, in terms of the overall view, nothing that would get you excited right here if you're a bull. From a technical perspective, looks like I have the 60-minute chart on the S&P up first. So again, S&P was up a little bit today, 29 basis points, but we have what would be an ascending triangle pattern, and that could be bullish or bearish. Typically bearish, and certainly it is when you have momentum rolling over in a bearish fashion. So you have a negative divergence here, really short-term stuff. On the 1-year look, it's just the same. I can just rip through these because it's the same patterns. Here we are inching into new all-time highs, and that's a better line there. You know this pattern, and you know these divergences. So concerning look on the daily, frankly, from a longer-term perspective, I'm more concerned with the look of the weekly. Slower moving, I think more telling from a trend standpoint and expectation standpoint. So on the weekly, again, peaking into all-time highs. and not confirming that yet on the momentum. We might in these two, peak to peaks right there, but the longer term look is one of quite the negative divergence there on the MACD. Here we were at the previous all-time high. Here we were with negative divergences, and you saw this happen. This is that chart that I showed you last time, so I don't need to get into it. Opposite look here when things were taking off. So again, absolutely could continue to melt higher. Maybe earnings will make that happen, but the technical picture doesn't feel real comforting right here on the short-term basis. Qs, NASDAQ 100, same thing on the hourly and on the weekly, frankly. We'll just look at the daily. Again, overbought notably on the daily. Last time we were overbought. We took this leg lower. When we were overbought here with these big divergences, took a more significant longer term leg lower, and yeah, a little bit of corrective action in here off of barely overbought territory. I know this just looks like more of the same. We'll just look at the daily really quick on the Russell 2000. So I think right here, obviously right here, we would call this a failed bear flag pattern. Looking pretty good right here, but we would have needed to almost touch that 200-day moving average for that to play out like the textbook says it should have. Instead, we came off of these levels of support that we identified right here and bounced big time, even gapped up here a day or two ago, right? Now, the problem here is that we hit what has been some pretty serious resistance, right? So think of it in terms of, folks who wish they'd have sold here as this happened were now given a second or a third or a fourth shot at it. So they jumped on it here. So it sold off of that, big time. This blue candle means it actually closed down on the day after having a pretty nice ramp earlier on. And yeah, our ultimate base case, just because of our macro view right now, is that the Russell and the other major averages have the potential for some serious downside risk to come at some point, probably during the course of this year, or the conditions that are supporting these concerns actually abate and clear up, and then we'd have a different story to tell. So this is not our bias or personality. This is just what the data or the information and the technicals and so on are telling us right here. Yields, lately, as I mentioned earlier, to some degree, equities have been bucking the yields. The S&P, certainly, not necessarily all of it, as I showed you in the sector look. But if I'd have known this was going to happen, although the bear flag was calling for it, I would have said that we should probably see stocks lower. And again, keep in mind, we're focusing on the major averages. A lot of stocks have been trading lower amid these higher interest rates. And then lastly, looking at the dollar. Again, pretty bullish look here. I showed you that this breakout and the momentum was saying it's going to break out to the upside. It did. Had a strong day in the dollar today. And again, the dollar was up. Stocks were up, except for a few sectors. And gold was up as well. Silver was up big. Now, silver's been getting pretty hammered. I didn't pull up the silver chart, but the chart on silver has been looking pretty constructive here, at least technically speaking. So silver was up 1.53%. And I'm looking at our Brazil ETF, which is a real commodity-oriented place in the world, was up 1.86% today, while the dollar was higher. Typically, there's a negative correlation between a Brazil, for example, and the U.S. dollar. So, again, interesting dynamics to say the least. I think there's a lot of noise, sector by sector, when we look at it in the aggregate, both from a sector perspective, global perspective, and so forth. This just looks like a really noisy setup. We begun tracking the S&P Dispersion Index, which is something that is an interesting thing to study. In fact, I wasn't going to, but let me just go ahead and pull that up and see what it looks like this morning. So you can see it's rising, which means dispersion is increasing, meaning the lack of cohesion or continuity on an individual security basis. So it's when stock selection becomes very, very important, obviously. And, it's not perfect, but you can see, if I draw a line up here, you can see it rising, and you can see stocks suffering for the most part during that period. I don't know, not so much here. So you had rising dispersion, Coming off of that, you had quite the correction. Here we have dispersion rising and stocks falling, dispersion falling and stocks rising. And you can go back here, and you can see during the COVID scenario, huge dispersion as the market fell. What do we have here? Pretty rapidly rising dispersion with a pretty rapidly rising S&P. So we'll keep our eye on that too and see if this plays out like it has during other periods of rising dispersion. So folks, I'll leave it right there. Appreciate you for hanging in there this long. Hope you have a great rest of the day, and I'll be back at you soon. Take care. Bye-bye.